As of the final closing bell on Friday, November 28, Applied Digital Corp. (APLD) is trading at exactly $27.10 per share, having surged 8.66% or $2.16 during the active session. The momentum continued into the after-hours market, where the stock ticked up another 0.77% to sit at $27.31. To the uninitiated observer scrolling through a Fidelity mobile app or checking their Robinhood stock trading watch list, this nearly 9% green candle looks like typical volatility for a company that many still confuse with a Bitcoin miner. The expectation is that this movement is just another speculative ripple in the crypto-adjacent pond, a sympathetic move tied to the broader digital asset rally. The reality, however, is that Applied Digital has effectively graduated from that ecosystem entirely and is now executing one of the most significant infrastructure pivots in the market. We are not watching a miner get lucky. We are watching a company that has just confirmed it can deliver industrial-scale AI factories on time and on budget, securing a massive $5 billion lease that validates its transition to a pure-play high-performance computing HPC landlord. The tension here is between the lingering crypto stigma that suppresses its multiple and the hyperscale reality that should technically value it alongside major data center REITs. To understand why this $27.10 price point is a critical battleground, we have to dissect the news that triggered this buying pressure. It wasn't a vague promise of future tech, it was concrete execution. The company announced the successful energization of the second 50-megawatt phase at its Polaris Forge 1 campus in Ellendale, North Dakota. This brings the building's total capacity to 100 megawatts, fully online, fully energized, and ready for revenue. In the world of data center construction, delays are the norm. Power constraints, supply chain bottlenecks for transformers, and cooling issues often push timelines back by quarters or even years. For Applied Digital to hit this ready-for-service milestone on schedule is a massive signal of operational competence. It tells the institutional capital, the folks managing Fidelity mutual funds or Schwab Intelligent Portfolios, that this management team isn't just selling slide decks, they are pouring concrete and flipping switches. This execution capability is what separates the pretenders from the contenders in the race to build the physical backbone of the AI revolution. But the reality that truly exceeds expectations isn't just the construction, it is the credit quality of the tenants they are attracting. The market was already aware of the deep relationship with CoreWeave, a major player in the GPU cloud space. However, the confirmation of a new $5 billion lease agreement with a US-based investment-grade hyperscaler for the upcoming Polaris Forge 2 campus changes the risk profile completely. When you move from venture-backed startups to investment-grade tenants, your cost of capital drops and your valuation floor rises. This deal effectively underwrites the company's expansion for the next decade. It provides the kind of recurring revenue visibility that allows analysts to build 15-year discounted cash flow models with a straight face. For an investor engaging in online investing or using SoFi investing to allocate capital, this shift from speculative growth to contracted infrastructure is the moment where a stock often undergoes a violent repricing event, which is exactly what we are witnessing on the chart. Despite this bullish backdrop, the stock remains highly volatile and there is a contrarian angle that needs to be explored. While the revenue backlog is exploding, now sitting near $16 billion if you sum up the lifetime value of these contracts, the balance sheet is undergoing a massive stress test. The company recently completed a $2.35 billion private offering of senior secured notes. While this cash is necessary to build these billion-dollar campuses, it loads the company with significant leverage. You're essentially betting that they can build these facilities fast enough to generate the cash flow needed to service this debt. If there's a hiccup in construction or a delay in chip delivery from NVIDIA stock or others, that debt becomes a heavy anchor. Furthermore, we saw insider selling recently, with the director offloading shares. While insiders sell for many reasons, seeing a sale right as the company announces major wins can be interpreted as a signal that the easy money has been made. It forces us to ask, is the current valuation of nearly $7.5 billion pricing in perfection? The trading volume on Friday was immense, hovering around 20 million shares, which is a clear sign of institutional rotation. We are likely seeing the exit of the last remaining crypto-centric funds and the entry of infrastructure and growth-focused heavyweights. This rotation often creates choppy price action as different classes of investors fight over the direction. For those using interactive brokers' trading platforms to track order flow, you likely saw massive block trades hitting the tape, indicating that big money is positioning itself for the next leg of this story. The stock is currently trading above its key moving averages, but it faces psychological resistance near the $30 mark. A clean break above $30 would likely trigger a short squeeze, as there remains a skeptical cohort of short sellers who believe the AI bubble will burst and leave Applied Digital with empty buildings in North Dakota. Let's shift focus to the actual product, because data center is too generic a term for what Applied Digital is building. Traditional data centers, the kind that host your email or basic web servers, are designed for power densities of perhaps 5 to 10 kilowatts per rack. The AI clusters being deployed by companies like CoreWeave or used for training models like ChatGPT require densities of 40, 50, or even 100 kilowatts per rack. This generates an enormous amount of heat that traditional air cooling cannot handle. Applied Digital's AI factories are purpose-built for this thermal reality. They utilize advanced liquid cooling infrastructure and closed-loop systems that allow them to run these chips at maximum performance without melting down. This architectural advantage is their moat. It is not easy to retrofit an old data center for this. It is often cheaper to build new ones, which is exactly what APLD is doing. They are providing the housing for the most expensive and sensitive hardware on the planet. If you own NVIDIA stock, you need Applied Digital or someone like them to actually plug those chips in. However, we must address the customer concentration risk. A huge portion of their backlog is tied to a very small number of clients, specifically CoreWeave and this new unnamed hyperscaler. While these are strong partners, any operational failure at CoreWeave, say a slowdown in demand for their cloud services, would hit Applied Digital immediately. They are not a diversified REIT with thousands of tenants. They are a concentrated bet on the success of a few major AI players. For an individual brokerage account holder, this means the stock carries idiosyncratic risk. You are not just betting on APLD. You are betting on their customers' ability to keep paying the rent. This interconnectedness is often overlooked by retail investors who see AI and hit buy on the Robinhood app without reading the fine print of the 10K. The financing aspect deserves a closer look because it involves some heavy hitters. The involvement of Macquarie Asset Management is a massive vote of confidence. Macquarie is one of the world's largest infrastructure investors. They own airports, toll roads, and utilities. They do not throw hundreds of millions of dollars at vaporware. Their decision to provide equity funding and preferred equity facilities suggests they have done deep due diligence on the assets and the contracts. This institutional stamp of approval is arguably more valuable than the cash itself, because it signals to the broader credit markets that Applied Digital is a bankable entity. It lowers their future cost of capital. For those using Fidelity Wealth Management or similar advisory services, seeing a name like Macquarie on the cap table is a green flag that often precedes a period of stability and maturity for a volatile stock. Now, let's look at the future outlook through the lens of supply and demand. The demand for AI compute is currently insatiable. Hyperscalers are engaged in an arms race to secure power and space. The bottleneck has shifted from getting the chips to finding a place to put them. Applied Digital has secured the land and, more importantly, the power agreements in North Dakota. Power is the new gold. Getting a utility to sign off on 400 megawatts of capacity is not something that happens overnight. This pre-secured power capacity is an asset that does not show up fully on the balance sheet, but commands a massive premium in the real world. In 2026 and 2027, as these facilities come online, the company's revenue is projected to ramp significantly. The expectation is that they will transition from a company burning cash to build to a company generating massive free cash flow from long-term leases. The risk is execution. Can they keep building at this pace without cost overruns? And will the pricing power hold up as competitors like Digital Realty and Equinix aggressively expand their own AI capacities? There is also a regulatory angle to consider. Data centers consume massive amounts of water and electricity, raising environmental concerns. APLD's focus on sustainably engineered facilities is a strategic hedge against potential regulations. By designing for efficiency and using North